Hey everyone, it's Matt with Down2Trade. It's Monday, May 31st, 2022. After a nice holiday yesterday, we got into a nice Tuesday trade today. We were in the position for all of 23 minutes today for a nice quick win. Now, you may be asking, Ahmet, you've been in and out of trades so fast lately, it seems like you're a scalper. And I'll admit, lately it does seem that way. But there's a good reason for it. And anyone who's watched my videos or who has traded with me in the past can tell you that I've not been very aggressive lately. I've been okay with closing out below my daily goal, which didn't happen before. I've been setting take profits almost daily, which means I'm done trading before I've even finished my morning coffee. I've been more cautious in my defense. I'm just overall trading very differently lately. But all of it is for a really good reason, and that's what I want to talk about today. How do we increase our probability of profit and increase our win rate, which increases your expected return? All of this to increase your overall return. We'll get to that, but let's start by talking about risk. If you've watched my video from last year, which originally was more than an hour long, but which I recently condensed down to a little over 30 minutes, you will see that my risk reward ratio is typically 2 to 1. Now, let's break that down to see where that comes from and how we might alter it depending on the market. The example we're going to use today is the position we actually took this morning. As you can see at 9:41, we got into the 42.40 by 42.10 bear call spread for 70 cents. We sold to open the short leg for 85 cents and bought to open our long leg for 15 cents. At 10:04, our take profit was triggered on the entire spread at 30 cents for a 40-cent premium capture. After commissions and fees, we ended our day at 0.7% return. Now, as we discussed earlier, I'm not being very aggressive in this roller coaster of a market, especially with everything I have to get done with our trade room launch coming up in just a couple days. Plus, I've been having a fantastic win streak here, and I really don't want to mess that up for some reason. I'll be happy with a bunch of small wins in this market. But what I want to talk about is why this is different from what I do in lower volatility markets and how this impacts our win rate and our risk profile. So, real quick, let's take a look at our charts. It's the same setup as always. The 1-minute SPX on the left and the 5-minute volatility and E-mini futures in the middle and on the right. The green arrow on the SPX is where we entered our bear call spread for 70 cents. And the red arrow is where we were triggered out of our take profit for a 40-cent premium capture. I was really thinking about getting into another position to get the rest of my daily goal, but I had too much going on today, so I stayed out. But let's look at our position management. So again, our net credit this morning was 70 cents. And I believe my probability of profit at entry was around 95 to 97%. Remember, for bear call spreads, I go a little bit further out of the money at around 4 to 6 delta. Typically, if the VIX opens at less than 20, I'll consider that a low volatility market. If it's between 20 and 25, I'll consider that a medium volatility. And anything above 25 is high volatility for me. Now, these are my parameters. You may have completely different metrics for how you gauge the market, but these values work for me. Now, for this discussion, we're only going to discuss high volatility versus low volatility. So, when volatility is low, as you know, our daily goal is to increase our account size by 1.5%. And we do this by selling enough contracts to meet that goal with 80 cents of premium capture. If you want to know how I calculate that, let me know in the comments below, and I'd be glad to cover that in some other video. But we set our stop at 3 times the credit received on our short leg. So in this case, I placed my stop on my short leg only at $2.55, which is 3 times 85 cents. Now, you may have noticed that this is more than 3 times the net credit of 70 cents. 3 times 70 is $2.10. But remember, if the position goes against me, I will gain premium on my long leg that I'm still in, which would typically round me down to that 3 times amount. More often than not, I'll even get out for a better premium. For instance, if I then sold to close my long leg for 45 cents, my net debit would be $2.10. So in this case, I received 70 cents, and if I got stopped out, I would have been debited $2.10. So I'm really risking $1.40 to make 70 cents. That's where I get the 2-to-1 risk reward ratio. So on any given day, I try to risk 3% to make my 1.5%. Again, my 2-to-1 risk reward ratio. So that's the risk side. What about the win rate side of the equation? Well, by placing our stop, we're actually lowering our probability of profit by approximately 10 to 15%. So instead of having a 95% probability of profit, it's probably closer to 80 to 85%. And this can be seen in my overall win rate for the year, typically 82% win rate. Granted, it's been a little bit higher lately, but we'll discuss why that is next. But before we do, if you like this video at all, do me a favor and smash that like button for me. I love making this content for you, and it helps me continue to make them. Also, please subscribe to our YouTube channel at Down to Trade, and don't forget to hit that notification bell. Okay, so now let's consider the high volatility market. When VIX is above 25, this morning I think it opened at 27.7, I actually adjust my position management strategy to account for the crazier swings which are more likely to occur. My daily goal is now 1%, and we try to get this by capturing 55 cents. So my probability of profit is now higher than 80 to 85%. Just by setting a take profit that is lower, I've raised my probability of profit. It's back closer to 90%. You might say, well, so what's the drawdown? Well, the drawdown is that my risk profile has changed. My stop remains the same, 3 times my credit received, but now I'm only shooting for a 1% gain. So I'm still risking 3%, but only for a 1% gain. That's a 3-to-1 risk reward ratio. And there's the trade-off. But this trade-off actually has a better expected return than our previous values with the lower volatility. So you might ask, why not use these high volatility parameters all the time since the expected return is better? And that's honestly a very fair question. However, when I actually trade, I find that in the low volatility environment, my actual average loss is much lower than this predicted 3%. So I make better returns than expected using those parameters. So in the end, here are my parameters for a quick review. In low volatility, I'm looking for 1.5% return with 80 cents capture. In medium volatility, I'm looking for 1.25% return with 70 cents capture. And in these higher volatility days, I'm looking for a 1% return with 55 cents. In all 3 cases, I still set my stop at 3 times the credit received. But that higher risk reward ratio is now offset by a higher expected return because I will have a higher expected win rate. And that's the magic of this management system. Now, these are the most basic rules across the board. Obviously, we have several ways that we adjust all of these values depending on too many factors to discuss here. But luckily for you, this and more will be covered in our free courses. Anyways, this is why my win rate has been so fantastic lately. Because of this adjustment in how I manage my position, again, based on the risk profile that has been tied to market volatility. Please understand, advanced maths and data analysis are the 2 best strengths I have, aside from being a really great dad. I have done all the painful analysis and testing to arrive at these conclusions. And now I offer them to you in the hopes that they will truly benefit you. Anyways, I hope that made sense. If you need any clarification, please let me know in the comments below. If you'd like to learn more about our Down to Trade room and its performance this year, take a look at this video. And for those of you who don't know yet, we're going to open our Down to Trade room to the public in the next couple days. First, we're going to be launching our beta room, which will be limited to only 20 members. And then we're going to open up the room to everybody else shortly thereafter. The best part is we're offering this trade room at a 50% discount for the first 50 subscribers, so don't miss out on this. We're also making some real fantastic courses which are going to cover everything from learning the basics of trading to options and then our phalanx option strategy, with everything we talked about here and so much more. All of this is going to be absolutely free. Also, visit our website at down2trade.com, where you can submit your email address to be notified when our 50% discount pre-order promotion kicks off in the next couple days. Look for the link in the description below. Okay, everyone, I hope you got something out of this video. It's been a fun day, and I can't wait to see you the next time. Take care, and happy trading.